Mm.
Yes. In this video, we're going to talk about the 4Cs of mortgage lending. But before we do, let's back up a little bit so you know why I think this is so important. I bought my first and only engagement ring over 20 years ago, and I still remember the 4Cs of buying a diamond: carat, cut, clarity, and color. That's because the diamond industry has done a great job educating its consumers, and not to belittle the significance of a diamond or what it represents, but come on, you can't live in a rock. Okay. You can't live in a diamond. Better? Buying and living in your new home will have an incredible impact on every aspect of your life, but it's also a huge financial investment, and we want to make it easier for you to understand. In this video, we'll discuss the 4Cs of mortgage lending, and even though specific guidelines for each loan may differ, almost everything a lender looks at will fall into one of those 4 categories to determine your loan eligibility. Let's start by putting you in a position of a potential creditor, someone that's going to issue credit and or extend a loan. So congratulations, for the first part of this video, you are now the bank. And in your new position as the bank, if you're going to give somebody access to your money, it's pretty important to understand a few concepts. The first and most important being risk versus reward. What risk are you willing to take, and what is your reward for taking them? As the CEO of Bank of You, the board is going to want you to minimize risk and maximize reward, or you're not going to last very long. So let's look at how this works with an unsecured loan or a credit card that you may be more familiar with. Before you loan away your money, you're probably going to want to know your potential client's attitude about the credit that they've had in the past. This is reflected in the credit score. The risk of this type of credit to your bank is that you really can't do much to ensure that the money that you just shelled out gets paid back. And you're going to balance the scale by charging a higher interest rate and offering less attractive terms. And the amount of money you're going to offer, or your risk, will probably be relatively small. Some credit lines are considered secured, like car loans and mortgages. This type of credit is secured by actual property, which means the bank reserves a right to seize that property if the debt goes unpaid. These secured loans are typically much bigger and offer lower interest rates because there's a recourse for the bank to recover some of their investments. Because they are bigger and have an asset attached to them, you, as a responsible bank CEO that you are probably going to want some additional assurances to help mitigate your risk. And that's why the 4Cs of mortgage lending are so important to the bank. And if you're buying a home, why understanding them should be important to you. What are the 4Cs? They're credit, measured by your score; capacity, the ability to repay your loan; collateral, what's being secured by the loan; and capital, how much money you're putting into it and how much you have left over. The rules that govern each loan program regarding the 4Cs are called the loan's guidelines, and while these guidelines can differ dramatically from loan to loan, here are some general rules. Since we already mentioned credit, let's start there. A fantastic resource to understand more about your credit is www.myfico.com, and then go to the Learning tab. I'll put the link in the description below. Think of a credit report like a report card for how you've handled credit in the past. Your score is the numerical representation that allows lenders to anticipate your attitude towards repaying your new loan. Because we're talking about a very significant amount of money to buy a home, a bank is going to want to take a very close look at this credit, much closer than if they were just offering a small credit card or free credit information. As good as some of these sites are for monitoring your credit, mortgage lenders are going to pull a much different credit report, and the scores may be different than what you've seen. They're going to use what's often called a tri-merge, pulling from all 3 major depositories: Equifax, Experian, and TransUnion. All 3 are going to have slightly different scores because they're using different scoring models, and not all credit and debt reports to all 3 bureaus. Almost all mortgage lenders are going to throw out the high score and the low score and use only the middle score. If more than one borrower is on the loan, the lower of the 2 middle scores will be used. If there isn't enough information to generate 3 scores, a 2, 1, or even no score program may be available. The higher the credit score, the lower the risk to the bank. For mortgages, typically you need at least a 580 credit score. The scoring model considers several of the same type of credit inquiries within a 14-day period as one pull, so it allows you to consider a few different lenders without running the risk of those inquiries harming your score. Once pulled, your credit is usually good for 90 days. The second C is capacity, and it's measured in debt to income ratio. Your debts come in 2 parts: your housing debt, referred to as your front-end ratio, or your total debt, often referred to as your back-end ratio. Your housing ratio will take into consideration how much your house will cost you every month. This includes your principal, the money you borrowed, the interest, the money it cost you to borrow it, and your taxes and insurance that you're required to pay on the property. This is collectively referred to as your PITI. If your loan requires mortgage insurance and/or an HOA fee, these are also going to be included. Your total debt-to-income ratio includes all the other debts reporting on your credit in addition to your housing payment. The second part of capacity is usable monthly income. The definition of usable can sometimes change from loan program to loan program, but typically requires 24 months of provable, related job history and a reasonable expectation of continuance to make it usable. If you're an hourly or salaried W-2 employee, it's pretty easy as long as you have a 2-year history of doing that type of business. Self-employment, second job, bonuses, or commissions would all have to have a 2-year history and then would be typically averaged. Other income like Social Security, disability, child support, spousal support, alimony can be used, but they may carry some additional stipulations. Let's do a debt-to-income calculation for Joe and Jane. We'll start by using the income information they entered into their online application and the debt from their credit report. Their debt-to-income ratio for the house that they want to buy would be 24% front end and 48% back end, which is acceptable for the loan program they want to use. But when the underwriter looks at their numbers closer, things start to change from what Joe and Jane originally thought. For example, Joe didn't hit his bonus last year, and even though they rounded up for 2 years, Jane's only been on her current job for 18 months. So neither Joe's bonus or Jane's overtime can be used. And even though Jimmy and Jenny's dad has paid most of the child support, it hasn't been consistently met per the court order for the last 24 months, so that can't be used either. So rather than the $6,933 income they thought they could use, they're down to $6,233 worth of usable income, and their back-end DTI is now 57% and outside the loan's guidelines, and it can't close this way. But because they only have 4 car payments left on one of the cars, and their older daughter is making her student loan payment by herself on time for the last 12 months, the guideline on this loan program may allow us to eliminate those 2 debts from our debt-to-income calculation. They may also pay off and close one of their credit cards, thus removing that payment from their monthly debt as well. And by doing those 3 things, they're able to get back within the program's guidelines. The point is that sometimes debt and income numbers aren't calculated the way you'd expect them to be. And this is one reason why talking to and being completely transparent to an experienced loan officer that will take the time to understand your situation before you go shopping for your new home is so important. The third C is collateral. This is what you're buying, or from the bank's perspective, the asset that they would get back if you fail to make the agreed upon payments. The tool that the bank uses to assess the home's value is an appraisal. The appraiser will be randomly chosen by the Appraisal Management Company, or AMC, that your lender uses, and is there to give an independent opinion of value based on the condition, size, style, location, and other factors compared to other similar homes that have recently sold in the area. The appraisal also shows the overall livability and condition of the home, and in some cases, like FHA and VA, the appraisal may take on the additional role of evaluating the condition of the property as it relates to the safety, security, structural soundness, and marketability. We'll go more into appraisals and how they can affect your loan later on in the series, but for now, think of it as the bank's way of making sure the home is worth what you're paying for it. The last C is capital. This is how much of your money you plan on putting into the purchase and includes your down payment along with closing costs and prepaids that we'll cover later in the series. Loan to value, or LTV, is measured as the percentage of the home purchase the bank is lending you. If you put down 20%, it gives the bank a warm and fuzzy feeling because they're only lending 80%, and statistically, you're much less likely to miss payments because you have more skin in the game. But oftentimes, putting down 20%, especially on your first home, isn't very realistic. And this is where mortgage insurance, MI, or private mortgage insurance, PMI, come into play. Mortgage insurance is an insurance policy that protects the lender and the banking industry from borrower default. Now, I know that sounds crazy, but without MI, the risk to the banking system would be too great. Rates could swell back to where they were in the early 80s to over 18%, and the housing market could fall apart. So it is something you may have to deal with. MI is typically paid for as part of your monthly mortgage payment, but it may be packaged a little bit differently. For example, it could be bought out in the form of a higher interest rate or more closing costs. But if you can't reduce the first mortgage to 80% by putting 20% down or taking out a second mortgage, you will be paying for that higher risk in some form or another. If you're eligible, there are a few exceptions to eliminate MI, like VA loans, where the VA would take the risk as a benefit for your service. We'll talk more about MI in upcoming videos, but for now, just understand that it may be a part of your loan to offset the risk of a higher LTV. Any funds used in the transaction will need to be what's called sourced and seasoned. The lender will confirm where the funds came from and where they've been by analyzing checking, savings, stocks, bonds, retirement, and any other asset statements typically for the last 2 months. If there are any large deposits showing on your statement, most loan programs will require that they are explainable, verified and trackable by a third party, and from an acceptable source per the guidelines. For example, paychecks and bonuses from your employer or your tax returns are trackable, and they're acceptable. But money from your next-door neighbor for the sale of your old baseball card collection may be considered mattress money because it can't be verified, and therefore isn't usable. When in doubt, ask your mortgage loan officer before making any deposits you're not sure of. Any funds left over after closing are called reserves, and may be required depending on the loan program. The relationship and combined strength of your 4 C's will help determine your situation, and along with your goals, will aid your loan officer in determining your risk and therefore the available loan options you have. By working together, you'll both get a good idea of whether or not you will fit within the specific program guidelines. Some programs, like FHA, will put more of an emphasis on the condition of the collateral and will offset the risk with mortgage insurance, while most conventional loans are based more on credit score and LTV. The better your situation, the more programs may be available, and the better rates and terms you should be eligible for. So there you have it, the 4 C's of mortgage lending. And while it's impossible to cover everything in these videos, hopefully this gives you some insights as to what the lenders will be looking for in the next step, where the lenders get to know all about your 4 C's, and we'll cover that in our next video, the mortgage pre-qualification. Thanks for watching.